fear is now trickling down the supply chain. Joining us now is Brian Jacobsen, the chief economist at Annex Wealth Management. And Brian, this is what we're trying to figure out, because I have people arguing to me that the market reaction today tells you in some ways, even at the worst of it, that the markets are becoming inured to tariff talk. And then I have other people saying, well, no, now this back and forth means they have to kind of constantly deal with the threat. Which one is it?
Well, it's probably somewhere in between, right? I mean, that's typically the way that the truth works out. And I think that actually the market might be a little inured to this, as you put it so eloquently. I don't pronounce that quite as well as what you do. But until it shows up in the data, right? Until it shows up in the profit margins. And I think that's one of my big concerns here, is that it's a bit of a catch-22 for investors. Because with the fear of tariffs, knowing that they could be imposed at any time for any particular reason, what does that do to margins or inflation? Now, margins are elevated across the board if you're looking at the S&P 500, especially with the biggest names out there. But when you dig beneath the surface, margins aren't particularly high, say for consumer staples or for consumer discretionary if you exclude Amazon. And so are they going to be able to pass on those price increases, in which case the Fed is likely going to stay on pause for a while? That's not great for financing rates, especially for smaller cap stocks. Or is it going to show up in compressed profit margins and show up in the earnings numbers, which also isn't great for investors.
Right, and it's not great for small caps. So I thought it was really interesting at the lows this morning, the small caps were way underperforming. So the Dow was down about 1.5%. The Russell 2000 was down 2.5%. And the line, Brian, has kind of been, oh, you want to go with small caps. They don't have the pressure from the strong dollar. They're not as global. They don't have to worry about the tariff exposure. But if this all comes down to the Fed might be a little less likely to cut rates, well, then they have that problem all over again. You know, when profit margins aren't as strong, would they have that problem all over again?
Yeah, that's the way that I'm looking at things here is, you know, I do like mid caps for the long term. Small caps, you have the issue as far as the number of names that are profitable now or profitable in the future. But if we look back at 2018 to 2019, the part of the market that did the best during the trade war back then was large cap growth. It was the tech names. You had actually those areas outperforming despite their global presence. Now, most of that could be attributable to the fact that they actually got exclusions from those tariffs, right? So the tariffs, it was a smaller base, 300 billion versus now it's like 1.4 trillion as far as the base. The rate was lower. It was phased in. But plus you had companies like Apple and many others that were able to get exclusions from the tariffs. This time, maybe it'll be a little bit different, but I suspect that they're already probably lobbying for some exclusions if actual tariffs do go into place. So maybe large cap growth is a slightly better way to play this.
It's amazing, Brian. Last week, all we were talking about was DeepSeek and NVIDIA and AI. Last week was so last week ago. And now, of course, we're talking about tariffs. What is an investor to do? It's a frustrating, very busy time. Aside from listen to you and watch and listen to CNBC, how do we process this insane flow of information that's coming out in the last couple of days?
Well, I like the fact that you use the word process as far as how do we process the information. It's about what is your investment process? Stick to it, right? The way that we're looking at things here at Annex is focus on the fundamentals. Near term, there's that greater uncertainty about the outlook for the fundamentals, but what's the longer term? Because we will ride through this eventually, right? It might result in slightly higher prices, lower purchasing power for consumers in the near term. But really, if you map this out over the course of, say, 3 to 5 years, what does that do to your forecasts for those types of earnings? It might not move the needle all that much. So focus on the fundamentals, look for the valuations, considering that margins are likely going to come under some pressure. Growth expectations might need to come down to earth a little bit. And so where's that margin of safety? So really sticking to that process, I think, is the best way to kind of process your way through this.
And we'll see if names like Apple, which should theoretically have it, can kind of shake it off. And not, you know, have those supply chain. Because I was like a tailor. I didn't mean to make a tailor.
I would say that was quick, but I was going to say it was very swift of you.
Thank you.